Today we are going to learn about different kinds of risk that are associated with trading in CFDs. It is important to understand the risk associated with CFD trading before you start trading in financial markets. CFDs are a leveraged product. Leverage gives you exposure to the markets by depositing just a percentage of the trade's total value. Let's take an example. Let's say you want to buy 1,000 shares of company A at a share price of $10. Now, to open the trade, you would have to pay $10,000. However, with a leverage facility, you only need a margin of 10% to buy the same number of shares. If the company A's share price goes up by $2 and you close your position, then you would have made a $2,000 profit, but at a considerably reduced cost. If the shares had fallen by $2, then you would have lost $2,000, which is twice your margin deposit. This means that while you could make a potential profit if the market moves in your favor, you could just as easily make significant losses if the trade moves against you and you don't have the adequate risk management in place. Market volatility and rapid price changes may arise outside regular business hours when you're trading international markets. This can cause the balance of your account to change really quickly. If you fail to maintain a sufficient balance in your account to hold your positions, there is a risk that your positions will automatically be closed by the platform provider, resulting into account closeout. For example, if the current closeout percentage level is 50% and you have 4 trades open that each requires $500 worth of position margin, your total position margin requirement will be $2,000. If your account revaluation amount drops to less than 50% of the total margin requirement, which is $1,000, then some or all of the trades constituting the position may be closed out, potentially at a loss to you. The account revaluation amount is the sum of your cash and any net unrealized profit or loss. You should always monitor your account and deposit additional funds or close your positions to avoid the risk of account closeout. Gaps in stock market trading appear when there is a sharp rise or fall in the price of the stock and when there is no occurrence of the trading activity. The reasons for gap creation can be positive news released by the company, change in the trade analyst view, buying or selling pressures among the traders, public announcements of the company's profits, losses, etc. Let's talk about the gap ups. When the price of a financial instrument opens higher than the previous day's price, it is known as a gap up. And when the price of a financial instrument opens lower than the previous trading day, it is known as a gap down. Gap down occurs also when there is a change in investor sentiments. Let's say the price of stock A is at $30 and the next available price directly jumps to $32 as the company has declared a positive earning. As a result, there is no price available between 30 and 32, hence there cannot be any trading activity. This no trading zone appears on the chart as a gap. One of the effects of gapping can be that stop loss orders are executed at unfavorable prices, either higher or lower than you may have anticipated, and it depends on the direction of your trade. You can limit that risk and the impact of that market volatility by applying a GSLO or guaranteed stop loss order. Depending on the positions you hold and how long you hold them, you may incur holding costs. These holding costs are applied to your account daily if you hold positions on certain instruments overnight, that is past 5 p.m. New York time. Overnight fees for trading share CFDs are based on the underlying interbank rate for the currency of the relevant share. Holding costs may be charged or received depending on the direction of the trade. The resulting sum of all holding costs will be credited to or debited from your account as applicable and will be visible within your account history on the platform. So now we understand the risk of trading in CFDs. Please talk to your risk managers and financial consultants before deciding whether to start CFD trading. My name is Yogesh and thank you very much.